This is Jeff Baller with the Apartment Owners Association, and it is just a wonderful day, even with fires raging. We still have so much to be thankful for, and man, it really makes you be thankful for what you do have. And anyway, today we're going to be covering how a 721 upreit works from a 1031 exchange into that 721 upreit. Before we get into that, thank you for being a member with AOA. And if you're not, really want to encourage you to join. There's a join button down at the bottom. If you're a member but your membership's lapsed, there's also a renew button at the bottom or link at the bottom on YouTube, and probably on, hopefully we can get that up on Facebook as well. And some of you are watching from AOAUSA.com. Want you to know up at the, if you're watching on a computer, up at the very top of the screen, there's an icon that will take you to our YouTube channel. And we have a lot of stuff. I mean, even just recently, we had a massive legislative update for 2025. We had an on-site manager law update for 2025, top tax strategies for real estate investors. These are all just in the last week or so that we've done. And we really want to keep you updated on everything that's new. We've also made lots of changes to the lease agreement. And a couple things that are really strategic for people who own condos or single family homes, that it doesn't impact how the lease works for multifamily, but it just really makes it way better for the single family homeowners, condos, etc. And anyway, so yeah, there's been a whole lot. We have the maximize your AOA membership video as well. All of those are on YouTube, so you can watch them at your convenience. And so I want to encourage you to go there and check those out. There's a couple different tabs, so check those out. And if you're new, definitely subscribe and toggle over the notifications. Like, we're going to be releasing a video pretty soon for San Diego. When we did a seminar there, we recorded it, and it's just taken a little while to get it out, but that's going to be coming out pretty soon. And also we have in person, man, two double headers this week already. And I'll tell you, I'm like, gosh, for the number of people that are there versus the number of people that I know are members, man, the information you're getting there, it's fresh. It is similar content on the legislative update, but there's definitely some things that are specific to the areas where we're going, and we will be doing that one more time in Long Beach next week on Tuesday, the 28th. And yeah, so that'll be great. And that one's a double header too. It starts at 10 a.m. On February 19th is the big Bay Area Landlording Power Conference, and that'll be held at the Santa Clara Convention Center. And we have 7 speakers. It's going to be great. And I think we have 25 or so different vendors that'll be there. So that's really going to be a lot of fun. You can order a Brock's lunch or just bring your own. And then February 26th, we're in San Diego, and that's a doubleheader. Franco Simone will be speaking, and he'll be covering rental criteria, the move-in process, and among other things. So that'll be one that you, if you're in the area, that'll be great for you to see that. And again, for those of you, not again, but for those of you that are on AOAUSA.com viewing this right now, there is the blue help button down on the bottom right side of your page, and you can use that to type in a question, kind of like a chat, and one of our staff will get that over to me, and we'll be able to ask the question. And so just a quick thank you to Real Estate Transition Solutions. They're a real estate investment advisory firm and DST experts. They have 4 offices on the West Coast, including one in Orange County and San Francisco. And they do definitely over 220 yearly in replacement properties. And anyway, just really thankful for them. And our speaker today is a partner and chief exchange strategist at Real Estate Transition Solutions. He's a CPA with extensive expertise in 1031 exchange strategies and tax deferral strategies. He leads Real Estate Transition Solutions team of skilled advisors and analysts, serving as both an advisor and advocate for owners of highly appreciated real estate, which is a lot of you. And he also regularly contributes to educational articles to highly acclaimed publications like Business Insider and the AOA magazine, which is definitely a highly acclaimed magazine here in the state of California. And so anyway, he has just incredible knowledge in this field. So I'm really pleased to have Austin Bowlin on with us. So nice to have you on. How are you doing there, Austin? Doing great. Thank you so much.
Excellent. And I appreciate the opportunity to share with the AOA community. As Jeff mentioned, today we're going to be discussing how one can sell an investment property and reinvest their proceeds, ultimately having ownership in real estate investment trusts. It's a multi-step process, but not all that complicated. And really the intent here is to address this question of, can I exchange directly into a REIT or a real estate investment trust? So we'll unpack that a little bit further. This is a effective exit strategy to be familiar with, whether it's for a sale that's occurring in the near term or possibly years in the future. We will be discussing real estate investment trusts and Delaware statutory trust 1031 exchange replacement property today. One item to note that is, if you are to exchange into Delaware statutory trusts, you must be what is considered an accredited investor. Typically, that means having a net worth in excess of $1 million, not including the value of your primary residence. Here you can see a quick overview of what we plan to discuss today. We'll do some foundational basic understanding and information as it relates to 1031 exchanges, just to make sure everyone has that baseline knowledge. And then we'll pivot into just what DSTs are, what real estate investment trusts are, and how one can use tax-deferred exchange proceeds from the sale of an investment property, be that a single-family rental or a multifamily property, and ultimately have REIT ownership. That'll be through a transaction structure that you may have heard of before that's referred to as a 721 UPREIT, UPREIT, or Umbrella Partnership Real Estate Investment Trust. We'll walk through a quick overview of the profiles for whom 721 UPREIT transactions we find are often a fit for, and then share some additional educational resources with the AOA community as well. As Jeff mentioned, we work extensively with investment property owners that are at a place where they're asking themselves, what could I do with my property if I no longer want to own it in its current form, but would also face significant tax consequences upon the sale? That's really our area of specialization as it relates to tax-deferred strategies that'll position a property owner to accomplish their financial and lifestyle objectives for the years and decades to come. We work extensively with what are broadly referred to as fractional ownership structures, the Delaware Statutory Trust, Tenant in Common, real estate investment trusts. And as Jeff mentioned, we've completed just over 750 1031 exchanges with our clients. On the DST specifically, we have just over $1.3 billion of DST real estate under advisement among our client base. And work with a number of different what are referred to as sponsors, but these are large institutional real estate firms to provide these investments to the investment property owner community at large. Quick glimpse at some of the key individuals on our team. As Jeff noted, we have offices down the West Coast. Our main office is up in Seattle, Washington. That's where I'm physically located, but also in San Francisco, Orange County, and in between the two in Portland as well. So with that, 1031 exchanges have been around for nearly 100 years at this point. And they're very popular for investment property owners because it is what enables a property owner to defer all the tax that would otherwise be due upon the sale of their property and keep those proceeds working for you. But apart from the tax savings itself, which are significant, it also provides quite a bit of flexibility as it relates to, we'll call it rebalancing an investment property owner's portfolio to own investment real estate that's going to be a better fit for their specific objectives. You'll hear a term like kind used in association with 1031 exchanges, and often there's a misnomer where When like kind is presented, people assume if I own a single family rental or if I own a 10-unit apartment building and I'm going to have to purchase like kind property, that means the same property type. But in reality, the IRS's definition as to what constitutes like kind property is actually quite broad. And really, they're not focused on the property type itself, but instead the intent as to why that property is owned. All property held for business or investment purposes, regardless of property type, is like kind with one another. Additionally, all property located within the United States held for business or investment purposes is like kind with one another. So now it opens up strategies where someone can sell a property in, let's say, Southern California. Maybe they're selling a fourplex and then acquire as like kind property an industrial property in the Southeast, or a multifamily property, or hospitality property, or agricultural property. There is a significant amount of flexibility associated with being able to reposition into different property types and different geographic markets. There's a number of drivers that we commonly hear from property owners who are considering a 1031 exchange. Some are tired of the day-to-day management or oversight of third-party property management, and they're interested in learning more about passive replacement property options where there is no management responsibility. Others would like to increase the cash flow that they're earning from their investment real estate. So this commonly surfaces with people who own single-family rentals or rental condos, because those values have appreciated so much, yet often we don't see the income growth holding pace with that. So it's not uncommon to see a return on equity or a cash on cash return be as low as, say 2.5, maybe 3%. And there are plenty of replacement property options that would allow for a meaningful increase in income. Others are looking to stage from an estate planning standpoint or escape a regulatory environment that they feel like has been burdensome and cumbersome. But if one were to not perform an exchange, if they were to pay tax, in California, you could be looking at a tax rate as high as 42.1% upon the sale of the property. So by doing an exchange, you keep all those proceeds working for you, and we can work with a property owner to ultimately acquire replacement property that's going to address whatever their specific objectives are. Now, many property owners who are looking to invest in different property types may not feel comfortable acquiring a property type they don't have a lot of direct hands-on experience with themselves. And that's really where the Delaware Statutory Trust becomes an effective solution of, say, selling a single family rental, selling a fourplex, selling a 10-unit, whatever it is that you may own today, and then being able to not only acquire different property types that have different return profiles and behave in market conditions in their own unique ways, but in fact diversify among multiple different property types. What you see here is a quick glimpse at, call it the 8 primary property types that we work with in the Delaware Statutory Trust structure. And there are about 4 or 5 others as well. But Delaware Statutory Trusts as a replacement property option have become increasingly popular, to the tune where we're seeing on average somewhere between, say, $7 to $12 billion of DST real estate acquired on an annual basis by individual owners who are saying, I'm ready to move on from owning and managing my own property, and I'd like to invest in something passive that should be more stable and predictable from a value and from an income standpoint, diversify my asset base, and then also be well poised to stage for estate planning purposes for the years and decades to come. Now, Delaware Statutory Trusts are not a silver bullet. It is not the perfect replacement property option for every owner profile out there. It's important to understand that DSTs are an inherently illiquid investment. Typically, we see a 5 to 7 year hold period before that property is sold. And it is a passive investment, which means you need to feel confident in the management expertise and the track record of the sponsor who is managing that property itself. And we absolutely can discuss in more detail the rigorous due diligence process from a sponsor and property type standpoint that all of the DSTs that we work with go through before they're ever shared with a property owner. Now, changing gears and focusing instead of the DST onto the real estate investment trust, As I noted before, we often receive a question from property owners of, can I exchange directly into a REIT? So we're going to talk about that. And first, it's important to understand just what a REIT is. A real estate investment trust is a ownership structure that the IRS approved back in 1960. And specifically, it was intended to allow for investors to pool their capital together to purchase investment real estate and then have the income generated from that investment real estate be distributed to the investors in the form of dividends without being subject to corporate tax. So it's a pass-through entity. And there are rules and restrictions around what the REITs need to do in order to continue to have their preferential tax treatment, their REIT designation. Namely, 90% of taxable income needs to be distributed to the investors. There are limitations around what kind of investments they can make and assets they can hold within the REIT. But the general concept is it allows for individual investors to aggregate their funds to then ultimately purchase property and then reap the economic benefit of that property. Real estate investment trusts in and of themselves are often large, diversified portfolios of property. Now, some are property type specific, but in the context in which we work with real estate investment trusts, most are diversified. Owning everything from multifamily to industrial to self-storage to net lease retail properties, perhaps a little bit of commercial office or hospitality, student housing, et cetera. And unfortunately, because of the, we'll call it structure of the real estate investment trust, one cannot perform a 1031 exchange directly into a REIT. However, there is a transaction structure that allows for tax deferral into a REIT, and that is what is referred to as a 721 uprate. Now, anytime you start stringing together numbers and acronyms, it starts to feel a little bit overwhelming and can seem complicated. But the 721 uprate transaction is really just the REIT absorbing a property into its portfolio. And instead of giving cash consideration to the owners of that original property, like a traditional purchase and sale would entail, ownership of the REIT is given as consideration. So say you have a REIT that owns $4 billion of investment real estate, and there is a $100 million property that they are interested in including in their portfolio. They can absorb that property into the portfolio and then give shares to the owners of that property as consideration. Therefore, and thereby providing tax deferral to the owners who now own a portion of this larger portfolio, this $4.1 billion portfolio. And 721 uprate transactions have occurred for decades. Problem with the 721 uprate, though, is in order to be seriously considered for an absorption, one has to own a property that would be of interest to that REIT, which typically means an institutional property, say a 50, 100, $150 million property. Most of us individual property owners do not own real estate of that size, at least not in its entirety, which then begs the question of why are we talking about this? How can an individual property owner ultimately utilize a 721 uprate transaction? And the answer to that lies with the Delaware Statutory Trust. About 12, 13 years ago, we started to see REIT managers actually structure DSTs outside of the REIT itself to accommodate a 1031 exchange. And what is in effect happening here is the REIT is saying, this is a property that we've either purchased or we've pulled out of our REIT that we know that we want in our portfolio. And we are going to structure it as a Delaware statutory trust to be able to accept exchangers into the property. And then after holding that property, seasoning it for 2 years, we will then absorb it up into our larger portfolio. So the steps for an individual who may own that single family rental or that fourplex or that 10-unit apartment building now become sell your property to whomever is willing to pay the most for the property, exchange into a Delaware statutory trust that is then intended to participate in a 721 uprate transaction. And then after a period of time, typically 2 years, your ownership will now be held in operating partnership units of the REIT at large. Now, I'm using the term operating partnership units because that is the technical term for it. But operating partnership units behave in the exact same way that REIT shares would, from a distribution standpoint, from a value standpoint. And once in the REIT, one can elect to sell their shares should they please or should they need liquidity down the road. We touched on some of the benefits of the traditional Delaware statutory trust structure earlier, but there are some additional benefits associated with the 721 uprate structure. Namely, once you are absorbed up into a real estate investment trust, your diversification among the value of real estate and the portfolio size increases significantly. So you can exchange into owning a single property or multiple different DSTs, but when that property is absorbed in the REIT, you may now have fractional ownership of quite literally billions of dollars of investment real estate. In some regards, you could view it almost as an index fund of institutional real estate. Another benefit for certain profiles is the fact that once you are in a real estate investment trust, you now have ownership of a perpetual life entity, which means you will not be faced with future 1031 exchange decisions on that, call it 5 to 7 year cadence. Now, for some people, this is a benefit. They value the simplicity. Others like the discretion and the flexibility around deciding what they want to exchange into next. So that is in large part dependent on the profile that we're working with. And then finally, liquidity. So liquidity in the REIT comes in the form of ultimately selling your shares. And if you were to sell your shares before someone were to pass away and a step up in basis realized, meaning all of that tax liability that has been deferred by way of the 1031 exchange, by way of the 721 uprate absorption, that would be due upon the sale of a share unless you own it until someone passes, and all of that deferred tax liability is then eliminated. Some people utilize the 721 uprate structure so that then they can intentionally liquidate shares over a period of time and spread their tax liability out over multiple years. In many regards, it's almost like a seller-directed installment sale. Others utilize it because they know that there will eventually be a death, a passing of one of the owners, and at that point, they want the surviving spouse or the beneficiaries to then have the flexibility to liquidate those shares immediately upon the passing of that individual. Now, just like the traditional Delaware statutory trust structure, 721 uprate DSTs are also not a silver bullet. There are considerations that owners need to be aware of when considering this and evaluating this as a suitable replacement property option. The largest distinction between the traditional DST and the 721 uprate is the fact that you lose your flexibility to perform future 1031 exchanges. Ultimately, you can continue to own your REIT shares as long as you would like. However, if you sell shares again before that step up in basis, you do not have the option to 1031 exchange out of those shares. Additionally, there's more flexibility for a REIT manager to be, we'll call it actively managing the investment real estate portfolio within the REIT. And what I mean by that is, in a traditional DST structure, if a property is to be sold, when a property is to be sold, at that point, all of the sales proceeds legally must be distributed back to the investors, including any appreciation the property realized, thereby enabling each investor to make their own independent decision as to what they want to do with their portion of the proceeds. And that could be perform another 1031 exchange, back into a new DST, back into a property in the local market, or of course, recognize their liquidity and either pay tax, or if a step up in basis is realized, then ultimately they'll probably just take their funds because they'll have little to no tax consequences. But you will only ever be invested in the specific properties that you selected. With the 721 uprate, once you are in the REIT, the sponsor can buy and sell real estate in that real estate investment trust as they please to navigate market conditions and market cycles. And there's not this requirement to distribute sales proceeds back to the investors upon the sale of a property. So the portfolio composition, if you will, can and will change depending on what the sponsor feels like is going to be most advantageous for the investors. Now, within the 721 UPREIT DSTs, there's two subcategories that are worth knowing about. What we refer to internally as hardwired UPREITs and what we refer to as hybrid UPREITs. The distinction between the two is whether or not the UPREIT transaction is being committed to at the time of the 1031 exchange into the UPREIT DST, or whether you have flexibility down the road to decide if you want proceeds to go do another exchange or to participate in a 721 UPREIT. Typically, we see a shorter hold period for the hardwired UPREITs. And importantly, the only investors who exchange into these specific DSTs are those that want to have a fast track and are committing to go up into the REIT. If you're unsure as to whether or not that's the direction in which you want to go, then perhaps the hybrid UPREIT model would be most appropriate for you. Here we see a little bit longer hold period, generally around 5 years. And then at the time of the exit from that property, the REIT will first offer cash to any investors in the DST who want to do a separate exchange or have liquidity, and then will absorb the remaining investors up into their REIT portfolio. So to wrap this all up, let's talk about some of the profiles of property owners for whom the 721 UPREIT transaction structure may be appropriate. First, there's that individual who says, I do not want to have to make future exchange decisions. They value the simplicity of ultimately being able to move their funds into a real estate investment trust and know that they can own that into perpetuity, continuing to collect dividend income from the REIT. And then when the time is right for them, whether that's before or after a step up in basis is realized, ultimately sell either all or a portion of their shares. Another profile is the person who values that liquidity. It could be for estate planning purposes. It could be because they fall in that camp that we engage with and communicate with all the time, who is property rich but cash poor, and they would feel more comfortable if they had access to funds at some point down the road. Another is someone who's motivated by maximizing their diversification. The real estate investment trust is how you can take a single asset, sell it, exchange it, and ultimately have ownership among quite literally billions of dollars of investment real estate. And then lastly, there's the estate planning considerations. The real estate investment trust ownership, the REIT shares or the operating partnership units, are very easily divisible among beneficiaries. They're also very clean to make charitable contributions with, if that's something that's in your estate plan. And because the liquidity is available on an ongoing basis, there would not be the potential that you would need to hold on to a property 2, 3, 4 years after a step up in basis is realized before ultimately generating that liquidity. So that's a quick glimpse of some of the common themes that we see for property owners in which the 721 UPREIT transaction is very much something worth considering. Now, how does one go about identifying 721 UPREITs? It really starts with a conversation with one of the advisors on our team. So what will happen in the context of that conversation is first and foremost education, making sure you understand the 1031 exchange process, the Delaware statutory trust structure, and then the subcategories of DSTs and the pros and cons associated with them. From there, once we understand your objectives, then we can start to narrow the field and share specific solutions and replacement property options with you. That approach, knowing that there is a very robust due diligence team supporting our advisors, evaluating these sponsors, their track record, making sure to underwrite each and every property acquired, is ultimately going to be what will best position you to accomplish those objectives over the years and decades to come. And as Jeff noted, 1031 exchanges can be complicated, and navigating that exchange process, whether we're talking about a co-ownership arrangement or a liquidity strategy, the timeline associated with the exchange, the replacement property value requirements and identification requirements, liaising with your tax preparer, that's a service that we provide, having drawn on hundreds and hundreds of 1031 exchanges that we've navigated with our clients in order to make sure that it is a seamless and effective transaction. If you are interested in seeing illustrative examples of properties that have successfully made it through our firm's due diligence process, you can visit our AOA hub. That website is re-transition.com/AOA, and you'll see a marketplace link there where anyone can see properties that are already fully funded. And if you want to see currently available properties, you can request access to do so. As far as additional educational resources available, if you have any questions from today's presentation or would like to speak to the specifics of your circumstances, reach out to us. We'd be happy to have a complimentary consultation with you. We will be able to point you in the direction of additional educational information, address your questions, and learn more about your profile and what solutions may be most suitable for you. Additionally, our guide to investing in Delaware statutory trusts is a great starting point for learning more about the DST structure. That's also complimentary and available for download on our AOA hub. So visit that page, download the guide, and then let's have a conversation after you had a chance to review it. And lastly, webinars are a near weekly occurrence here at our firm. Here you can see two of our upcoming webinars. Next week, we'll be hosting our 2025 Market Outlook. We'll look back at 2024, what occurred throughout the year, and then the state of the economy as it stands today, and our best guess, if you will, as to what will play out over the coming year. Additionally, we have an upcoming exchange strategy webinar here in early February, and we'd love to have you join for either or both of those. Well, that's all we have, Jeff. If there's questions that have come through, we can pivot to that. I also have some frequently asked questions here that I'd be happy to work through as well.
Watching on AOAUSA.com. You can type a question in there. If you're on YouTube, anywhere else, you can type in a question. And anyway, we will wait for you. And if you jumped on a little bit late, again, we have several different events that are coming up. And so if in person next week in Long Beach on Tuesday, and then also we have Dennis Block, even just 12 o'clock noon today, we'll have Dennis Block on, and he'll be going over some of the elements of a lease agreement that you need to have in there and things that you probably should have changed for 2025. And one of those is definitely SB 611, where it doesn't allow you to charge the $50 fee, one of those things that we had in the lease. And of course, you have people that are on existing leases, and basically just that part of the lease becomes invalid. But anyway, just want to mention that and give you guys a little time to put a question in. And anyway, with these uprates, the 721s, surely like there's a past performance and you're able to show kind of like where it's tracked since its inception.
Absolutely. Yep. We can see the dividend distribution rate since the launch of the REIT. Typically distributes cash flow on a quarterly basis. And then we can see the share price, the NAV of the REITs, and how that's trended. And when we talk about these diversified REITs, when I use the term kind of buying the market, if you will, it is in many regards kind of like a broad index fund across all property types. And so you'll see the macroeconomic factors being a major driver in value changes. What that's looked like over the last 10 years, say, is the values were year over year growing, even throughout the early stages of COVID. There was obviously uncertainty in the market in early 2020, and the capital markets largely dried up for about an 8-week, 10-week stretch. But investment real estate values, with the exception of commercial office, stayed quite resilient throughout that period, and then surged up in 2021 and 2022. largely as a result of borrowing costs dropping as low as they did. And in some regards, that was not sustainable appreciation, right? That was artificial due to stimulus funds, to having so much capital in the economy through the reduction of the Fed rate down to nearly zero. And then when the Fed began to rapidly increase interest rates, that impacted investment real estate values nearly across the board. And as a result of that, there's been, depending on the property type in the market, anywhere from a 10 to 15% price reset and value decline throughout the course of typically 2023, with it largely having stabilized out throughout 2024. And hopefully what we're looking at now is having found that floor, and then we'll have more sustainable long-term year-over-year value appreciation throughout the next cycle. Now, how long will that cycle be? Historically, investment real estate has, say, a 4.5 to 5.5 year cycle associated with it. The 2010s was an anomaly and an aberration where it was a 10-year cycle. That was the longest, sustained period of economic expansion in U.S. history post World War II. But we have to know investment real estate is somewhat cyclical. And if you're planning on investing over a 10, 20, 30-year horizon, then the cycles themselves are not all that significant, provided you do not elect to invest at the peak and sell at the bottom.
Right. So the 1031, the DST that they would be investing into would convert to a REIT after its regular cycle. Is that right?
It can be in as little as 2 years. If it's a hardwired 721 uprate, then the hold period in the DST itself is only 2 years. And that uprate transaction will occur sometime in that 2 to 3 year window. If it's going to be a hybrid uprate, yes, we'll see a longer hold period, typically closer to 5 years or so. And then the absorption by the REIT occurs. So the REIT is bringing that property into its portfolio. The individual exchangers, DST investors' ownership now converts into ownership of the REIT, and then that can be held as long as the individual investor wants to.
Right, and that it's getting that cash flow. So I know that it's quarterly, and we kind of know what performance has been on a regular DST. How would that compare? Like, what's the rate of return on this?
As it stands today, with REIT values being, say, 15% lower than peak pricing in 2022, we're typically looking at distribution rates for the REITs in the upper 5s to low 6% range. So it is slightly better than the traditional DSTs. I do think historically you're sacrificing some appreciation potential.
Right, yeah.
But, that's, in many regards, that's not the goal for someone going into REIT ownership. They want to have that diversification, the stability, the predictability, and have something that is entirely hands-free. Not only passive from a management standpoint, but no future investment decisions needed other than deciding on when to sell one's shares.
Right, right. And okay. And let's see. Yeah, so we do have one question here. Are uprate shares privately traded or publicly traded as stocks?
That's a good question. So there are a few different forms of REITs from a registration standpoint. You'll have publicly traded, listed on the exchanges, say the NYSE, the New York Stock Exchange. Within those REITs, you're going to deal with a lot of volatility. It's very common to see REITs move 3 to 4% per day. They're not always down, then up, and then down. It can trend up and it can pull back. And if you look back at, say, 2024 as a good, 2020 as a good example of this, April 2020 specifically, the REIT index of publicly traded REITs declined something like 35–40% in about a 3-week period because of that uncertainty associated with COVID. But in reality, property values themselves did not move nearly that much, nor did they go down. They actually went up during that period. And so there can be a disconnect with the emotion and the volatility of the public markets. There is another category, which is what we typically work with, which is what's referred to as a public non-traded REIT. So here the REIT is public in the sense that shares can be bought and sold, and they're registered with the SEC, but the share price is determined based off of a valuation methodology. And that's using an ongoing appraisal cycle where every property within the portfolio will be appraised on an annual basis, but some in January, some in February, some in March, and so on and so forth. And it's the changes in value that ultimately dictate the movement in the share price. There's private REITs, which can take a various ways and forms. Some of those private REITs will be entirely liquid, meaning there's no ability to sell shares down the road until the actual REIT portfolio is liquidated, the underlying property sold, and then the sales proceeds distributed back to investors. But there are also private REITs that function the exact same way as public non-traded REITs, with the only major distinction being the fact that one has to be an accredited investor in order to directly invest in those REITs. So these NAV REITs are typically what we are working with, where they have that valuation methodology. The share price doesn't change all that much month to month, although it will move over time. And then the distribution rate is set by the REIT sponsor.
Okay, great. Thank you. And Ted, my question would be, if you pass away in the term of a 7 to 10 year DST, how is the property valued for your real estate, for your, I'm sorry, for your estate purpose?
Yep, that's a great question. So it depends on a couple components. One is, what's the date of passing relative to your most recent transaction? If it's within a year or two, we may just use that transaction value. The second is, how has the market changed, if you will, between the date of your most recent transaction and the date of passing? If there were significant changes because interest rates went up dramatically or declined dramatically, whatever it may be, then we may do an actual valuation on your specific ownership. And that can take a number of different forms. It can be comparing the cash flow on the property relative to those DSTs that were recently acquired and currently available, and extrapolating the change in value between those two. It can be actually going to the underlying real estate and having that property appraised, doing a comparable sales analysis. So there's a number of options, and the right approach is going to depend on, how much certainty someone wants to get on that value, and then also the size of the investment and the size of the overall estate.
Gotcha. All right. Land Baron asked about the typical return and how often distributions are. You already answered that question. It's quarterly and 5 to 6%. Right now, of course, that's past performance, and no promises for today or tomorrow.
Quarterly for the REITs specifically, all of the DSTs will distribute cash flow on a monthly basis.
Yes, and Land Baron, here's another one. 3-unit apartment owned by me and a sibling. One needs instant money. Other wants to hold till death. What options do we have?
If one needs capital now and the other one doesn't want to actually sell the real estate, you really have one option and 2 ways to get there. Or well, we'll say 3 ways. You can buy out your sibling, in which case, if you own it in an LLC right now, you can keep that LLC in place. That can come with your own capital, that can come with a partner's capital, or that can come with potentially refinance proceeds. Those are largely your 3 options. Alternatively, you could sell the property itself, and if one wants to recognize tax and the other one wants to continue to have tax deferral, there would likely need to be some legal entity restructuring occurring before the sale itself. And that's something that we would be happy to have a conversation about. We work through that scenario regularly.
Yeah, and you are a CPA.
That's correct.
But you're not giving tax advice, it's just, but you know enough, and you've been around real estate your entire life.
That's correct.
All right, Mike, can I exchange our solo 401k property to a REIT?
So if you own a property in a 401k, that's a qualified account. And you likely are not actually going to recognize any tax upon the sale of it. Similar to if you hold it in an IRA or another form of qualified account. So while the answer to that is yes, you can, you probably do not need to. You could just sell the property, take the proceeds, invest into whatever it is that you want at that point. That very well could be REIT ownership, but you don't likely need to perform an exchange.
It's already sheltered, basically, right?
Exactly.
Great. Well, guys, thank you for your questions. If you have anything else, let us know, and we'll put it in the chat, and we'll get it up to Austin here real quick. Austin, what do you think? You think interest rates are going to go up or down? I know you don't have a crystal ball.
I think that they're going to hold stable for the next 3 to 6 months, maybe a little bit less than 6 months, maybe 3 to 4 months, and then they'll start to slowly work their way down. And I think the tariff talk and conversations really the wild card that's keeping them up right now. And depending on what sort of movement we see on that front over the first 1 to 2 quarters of this administration, then there will likely be more confidence in the economy and saying, okay, we're not going to fundamentally overhaul our trade agreements at that level. Not to say we should or we shouldn't. I think that the talk itself is a negotiating chip that creates leverage with other countries. And then ultimately, they will work their way down, not back to where we were in 2020, 2021, 2022, nor should they be there. But they will come down, maybe 100 basis points, 125 basis points gradually over, call it 12 to 24 months. And then we'll settle in. And that should be a good place to be.
All right. Well, there you go. That's the one that everybody's waiting to see what happens, I think.
Yeah.
Especially when it comes to selling. And here's one thing that you're in control of. One thing that you're in control of is your property right now. And we always set goals every year. You write your goals out, and you're successful people. And one of the questions you could ask yourself, here we are still in January, you could ask yourself, okay, what is one area of focus that I can pick for this property or for my properties where I can increase the revenues that are coming in, or conversely, what's one area where I can decrease my expenses and therefore, adding more value to your property? What's one thing you could do? And so that's something you could focus on throughout the year. And when you come to the end of the year, you're gonna be better. You're gonna be cash flowing better than you are today. And also, you'll look back and you'll feel like, you know what, I can't control everything, but at least I can control that. And maybe when you actually do go and sell it, then you'll be in a better position and you'll have more to put into one of these 1031 exchanges. And I was at a landlording conference this last week, and I was speaking with a guy that's he owns thousands of units and does syndications and everything. And I asked him, he knows a ton of people. And I said, do you know anyone that has lost money in a DST? You know anybody? And he's like, I've never met anybody. And like, I haven't met anyone yet. And I know that's the big deal, is like, is this going to work? Am I going to lose my whole life savings if I put money into this? And I'm not saying that you're not going to, but it was reassuring to me just asking around, especially people that know so many people, that they haven't met anyone yet. And anyway, that was reassuring to me in a sense. And I don't know, Austin, you probably like hearing that because this is what you do.
I mean, we have a pretty big population to draw off of here, having been in this space for 20 years. And as I mentioned, we have just over $1.3 billion of DST real estate under advisement. We've only ever had one property have less than a full return of principal. And that was a sale that occurred in 2024. It was a 98.5% return of invested capital. And when we're talking about multiple market cycles, hundreds and hundreds of investments, it's a pretty strong track record. Returns are not guaranteed. It is direct ownership of investment real estate. That's why it's eligible for 1031 exchange purposes. But when properly done with the right properties, with the right sponsors, the right markets, yes, we can't control all the variables, but we can try to mitigate those risks as much as possible. And in many scenarios, it is much more stable and predictable than owning and managing your own property.
Right. And if you have property right now that you're just letting be vacant, I mean, come on, like either get a property management company to fill that thing and get you cash flowing, or maybe it is time to sell. But leaving it vacant is the last thing you want to do. I know that there's risk there, but let's make these things work, and yeah, let's make these investments work for us. But anyway, I appreciate all of you. Hope to see you. Well, I don't see any of you, but you see me. Hope that we'll be able to meet here at 12 to hear from Dennis Block about just key changes to lease agreements and what needs to be in there in 2025. So thanks, everybody. We'll see you next time.
Thank you, Jeff.
Thank you so much.